While producers were busy filing tax returns this season, there were a number of significant developments that went unnoticed by practitioners. Joining us now for a recap of those issues is Roger McEowen. He's with the Washburn University School of Law. Roger, as always, thanks for taking the time to chat with us. First of all, let's start with the Obamacare individual mandate. Give us a little background on that litigation and, of course, the outcome.
Yeah, good to be with you, Janet. There were a couple of things that happened this tax season. Actually, right before tax season started, we had a federal court down in Texas that said that because the TCJA, that tax act that was signed into law in late 2017, repealed the penalty for the individual mandate on the requirement to get health insurance under Obamacare. And because Chief Justice Roberts, in his decision a few years ago, based the entire constitutionality of that law on the penalty being a tax and therefore within the taxing power of the Congress, the Texas court said, well, since that is no longer in the law, then the entire law is unconstitutional. Now, that case is on appeal, so we'll have to see what happens with respect to that, but that's a big development.
Now, I understand there was also some confusion over how farm income averaging interacts with the Qualified Business Income Deduction. Can you speak to that?
Yeah, there may still be confusion on this one because of the way the IRS worded things. But basically what they said is if a farmer or a fisherman that is eligible to elect farm income averaging and actually does make the election, then you're going to have to base your income figure for purposes of computing your 20% pass-through deduction under TCJA on your farm income elected income amount. So I think what that says is if you're going to make that income averaging election and you do as a farmer, then you're going to have to use your elected farm income number to calculate your 20% pass-through deduction. And again, I think that's what they say. We may need further clarification from them on that.
Roger, now there was also some recent confirmation with respect to S corporations and the deduction for self-employed health insurance. Update us on that.
Yeah, this is an interesting one. Of course, S corporations are treated a little bit differently than partnerships with respect to deductions because you have employees in S corporations, you don't have employees in partnerships, and so that's an issue there. So there had always been a question as to how you handle the self-employed health insurance deduction for these more than 2% shareholders in an S corporation. And what IRS said is that they confirmed basically what we had thought. You're going to include the amount in your gross income in accordance with an IRS notice, and then the S corporation is going to set up the plan, providing the medical care and so forth. So, you basically what you're going to be able to do, the bottom line is you're going to convert what might be a non-deductible expense because of either the 10% floor for medical expenses or because the family member takes a standard deduction into an above-the-line deduction, and that's what we thought was going to be the case. IRS confirmed that.
All right, Roger, as always, thank you very much for your insight today. Roger McEowen, he's with Washburn University School of Law, joining us on the phone today from Topeka, Kansas.